Welcome back to Investing Talk Podcast.
Today we're looking at Clover Health.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah, let's do it, because this is a company that, the market has had a really tough time figuring out.
It absolutely has. You see this explosive growth on one side, but then these worries about profitability on the other.
So let's start with that growth. The top-line numbers are pretty staggering.
They really are, and it's all being driven by one thing: Medicare Advantage expansion. Purely. If you look at the financials, just year-to-date through Q3 2025, they hit $1.4 billion in net premiums earned.
Wow. And what's that as a year-over-year increase?
That's a 39% jump. 39.
Okay, and that's fueled by just getting more people signed up, right? The membership metrics must be through the roof.
Exactly. That's the core driver. Membership expansion is up 35% year over year.
So that's tracking pretty closely with the revenue number.
It is. They're at over 109,000 members now as of the third quarter. And, that's significantly above what the market was guided to expect.
So they're beating their own targets.
Yeah.
But here's the thing that always gets me with growth like this. How are they managing costs? Usually, a 39% revenue surge comes with a cost explosion.
That's the surprise here. And it's a huge part of the bullish story. Their costs are, they're surprisingly controlled.
How so?
The year-to-date underlying medical cost trends, and this is excluding pharmacy, have only seen about a 4% increase.
Wait, only 4%? While membership grew 35%?
Just 4%. It really validates the idea that their model, their whole system for managing utilization is working even as they scale this rapidly.
So they're not just adding members, they're adding them efficiently.
They're proving they can do it without the medical costs just, spiraling out of control.
But, and there's always a but, that doesn't mean they're profitable yet. That's the red flag for the skeptics, isn't it?
It is, and we have to address it head on. The GAAP net loss for 2025 year-to-date is around $36.2 million.
And that's the number that makes people nervous. They see the loss and they stop there.
Right. But that loss is completely explained by the significant upfront costs of bringing on new members. And they brought on a ton this year.
How many?
Over 44,000 new members added in 2025 alone.
Okay, so that brings us to the core of the whole thesis, right? This idea of cohort economics.
This is everything. If you don't understand the cohort dynamics, you can't understand the company. The story is in the difference between new and returning members.
So let's break that down. What does a returning member look like financially?
A returning member, someone who's been with them for more than a year, is incredibly profitable. We're talking $217 of contribution profit.
Per member, per month.
Per member per month. That's just premium performance.
But then you have the new guys. The 44,000 they just onboarded, they're the drag.
They are the drag. A new member posts a negative $110 contribution per member per month.
$110 loss.
Yes. But it's an investment. It's the cost of getting them set up, getting them into preventative care, establishing that baseline health management.
And that cost hits the books right away.
Immediately. So the whole question becomes, how fast does that negative $110 flip to a positive $217?
And is that flip predictable?
It is, and that's where the historical data is just so crucial. It's all about the medical care ratio, the MCR.
Which is just the percentage of premiums they spend on care. Lower is better.
Exactly. And what their data shows is just this phenomenal inflection curve over time.
Okay, so what does that curve look like?
When they track their cohorts, they see a 700 basis point improvement in the MCR between year 1 and year 2.
That's a huge jump in efficiency in just 1 year.
A massive jump. And it doesn't stop there. By year 3, that improvement actually compounds to a 1,400 basis point drop from where they started.
So the members that are costing them money today
are on a predictable path to become highly profitable in 2027.
And this is why management is so confident about 2026.
It's the whole reason. They're guiding to full-year positive GAAP net income in 2026, not based on some hope, but by just projecting this historical performance onto the huge new class of members.
You're basically buying the stock now during the period of maximum margin pain, just before that predictable flip happens.
That's the thesis in a nutshell.
But to run a strategy like that, with such heavy upfront costs, you need a rock-solid balance sheet. You can't be desperate for cash.
And they seem to have it. They're holding about $395.9 million in total cash and investments. It's a strong position.
And this is a really critical point for investors. No dilution risk, right?
Management has been very clear on this. They've confirmed the company is self-funding its growth.
So the fear of them needing to sell more stock to raise cash, which would hurt current shareholders, is off the table for now.
It seems to be. And their cash flow from operations is improving dramatically. They actually generated $49.8 million year to date, which is a huge turnaround from last year when they were burning cash.
Okay, so the financials seem to support this growth story. Let's talk about the how. What's the competitive moat that lets them manage costs so well while growing so fast?
It all comes down to their technology, a proprietary AI-powered platform they call the Clover Assistant.
This is their secret sauce.
It really is. It's what makes them different from a traditional insurance company.
So how does it actually work? I mean, what does it do for a doctor in an exam room?
So imagine you're the doctor. The Clover Assistant takes all the patient data claims, lab results, everything. And it doesn't just store it, it synthesizes it.
And give the doctor, what, a recommendation?
Actionable insights. In real time, it might flag something like, hey, based on this patient's A1C levels, they're at high risk for hospitalization in the next 3 months. You should intervene now with this specific drug or this referral.
So it forces proactive care instead of reactive care.
Exactly. And that's what drives down those huge catastrophic costs down the line.
And this is what lets them solve that classic dilemma in Medicare Advantage.
Right. The old trade-off. Do you offer a narrow network HMO to control costs, or a wide network PPO that members love but is usually more expensive?
Clover offers the wide network PPO, which is a huge selling point for members.
They do, but they use the Clover Assistant to manage the clinical performance and costs within that wide network.
So they get the best of both worlds.
That's the goal. And the numbers back it up. They hit a 4.72 8He quality score in 2025. Achieving that in a PCO model is, well, it's very impressive. It proves the tech is working.
And because the tech is the control mechanism, not a network of specific doctors, it means they can scale anywhere.
Virtually any market. They can go into underserved rural areas where competitors can't because they don't have those big integrated provider groups to partner with.
Which brings up this idea of optionality. They've realized this tech is valuable on its own.
Immensely valuable. And they decided to productize it.
With Counterpart Health.
Exactly. A standalone subsidiary they launched in May of 2024 to license the Clover Assistant platform to other companies, external payers, providers.
So suddenly their market isn't just their own members anymore.
Suddenly their total addressable market explodes. It could become a really high-margin, capital-light software-as-a-service business. A whole new growth story on top of the insurance business.
Okay, so the fundamentals look strong. Let's switch gears to the technicals. How does the stock chart look? Because it's been a volatile ride.
It has. But right now, we see the stock trading in what looks like a multi-month accumulation pattern.
Meaning big players might be building positions quietly.
That's the suggestion. It recently bounced hard off a capitulation floor, which often signals that the weakest sellers have finally given up.
And where is it sitting now, support-wise?
It's right in a foundational support zone. And if you look at the momentum indicators, like the RSI, it's sitting around a neutral 50.25.
Which is good. It means there's plenty of room to run to the upside before it looks overbought.
Lots of room. And the MACD lines are really close together, setting up for a potential upside crossover.
The kind of setup that often happens right before a big move.
And we know this stock can move. We saw that huge 532% run earlier in the year. When institutional capital decides to flow in, it flows in aggressively.
So what are the catalysts that could trigger that flow?
Two really big ones on the horizon.
The first has to be that 2026 profitability guidance.
That's number one, absolutely. Every quarter that they release data reinforcing that cohort trajectory, it just pulls that validation timeline closer and closer.
And the second one?
The star rating improvement. This is a massive financial tailwind for them.
They got a 4.5-star rating for their PPO plan, which is what? Almost all their members.
97% of them. And that rating isn't just a pat on the back. It translates directly into more money.
Higher payments from CMS.
Materially higher payments in 2026. It's extra high-margin revenue that makes hitting that 2026 profit target even easier.
Okay, we've laid out a pretty bullish case here.
Sure.
But we have to look at the other side. What are the big risks?
For sure. And the primary risk is always medical utilization reversion.
Meaning, what if people just start going to the doctor more?
Exactly. If utilization spikes unexpectedly, a new flu season, more elective surgeries, their medical costs could shoot past their projections.
And that would hit their margins immediately.
It could temporarily delay that 2026 profitability target. It's the big unknown in any health insurance model.
What about regulatory risks? They're totally dependent on Medicare.
And that's a huge exposure. Specifically, CMS has said they're going to significantly increase the volume of RADV audits.
Risk adjustment data validation audits.
Yeah.
Basically checking the paperwork.
Right. They check to make sure the risk scores assigned to patients, which determine how much Clover gets paid, are accurate. If they find issues, it can lead to retroactive clawbacks.
And finally, there's the clear skepticism baked into the stock price itself. The short interest.
Yeah, it's not insignificant. Short interest is currently over 10% of the float.
So there's a meaningful group of investors betting against this entire story.
They're betting that the cohort improvement won't happen as predicted or that some other risk will derail it.
But that short interest can also become fuel for a rally if good news hits.
It absolutely can. It sets up the potential for a pretty aggressive short squeeze if those catalysts we talked about materialize.
So when you put all these pieces together, it really does feel like a classic growth stock situation.
It does. The market punished it for the near-term losses, which were a direct result of its own successful, rapid growth.
The entire investment case really boils down to one question. Do you believe in the predictability of those maturing member cohorts?
That's it. You're betting on their historical data, their operational model, and the Clover assistant to deliver on that 2026 profitability promise.
For those looking for that rapid growth, paired with a really clear, data-driven path to profit, you have to keep Clover Health on your watch list.
The key is to follow that 2026 guidance and the cohort MCR data every single quarter. And of course, don't forget to subscribe to Investing Talk podcast for more analysis like this.